The SP 500 is one of the best wealth-building machines ever created. I want to begin there because in my experience, people usually make bad investment decisions when they start by trying to beat something they do not understand. The SP 500 is not a small idea. It is a simple way to own a large piece of the American productive system. It has averaged roughly 10% a year over long periods. Not because the world was calm, and not because investors were always rational, but because the system kept creating revenues, profits, innovation, and cash flow through wars, recessions, inflation shocks, banking problems, political uncertainty, and repeated panic. That is the baseline. But once you understand the baseline, the next question becomes more interesting. What happens if you can do slightly better? Not wildly better, not fantasy returns, not gambling returns, just slightly better. That small difference, repeated over enough time, is where most people misunderstand the math of wealth. If you start with $10,000 and earn 10% a year for 10 years, you end with roughly $26,000. That is good. There is nothing wrong with that. But if you earn 13% a year, that same $10,000 grows to roughly $34,000. If you earn 15% a year, it grows to about $40,000. And if you earn 17% a year, it grows to roughly $48,000. Now, many people hear those numbers and say, that does not seem like enough to change my whole strategy. That reaction is understandable, but it is also short-term thinking. The real issue is not 10 years. The real issue is time. Take that same $10,000 and stretch the time horizon to 30 years. At 10%, it becomes about $174,000. At 13%, it becomes about $395,000. At 15%, it becomes about $662,000. At 17%, it approaches $1.1 million. That is the power of small differences. This is one of the most important principles I have learned in markets and in life. The world often changes not because one big thing happens once, but because small differences repeat. A small edge applied consistently becomes a large result. A small mistake, repeated consistently, becomes a large problem. That is true in investing. It is true in business. It is true in behavior. It is true in countries. It is true in debt cycles. It is true in everything that compounds. So the question is not whether the SP 500 is good. It is good. The question is whether there are ways to intelligently seek a little more upside without pretending that risk does not exist. Because risk does exist. Anytime you invest, you can lose money. Anytime you try to earn more than the broad market, you are taking on more concentration, more volatility, or more exposure to a particular factor, sector, or theme. There is no free lunch. There are only trade-offs. But some trade-offs are more rational than others. The goal is not to blindly chase whatever went up last year. The goal is to understand why certain funds have historically outperformed the SP 500, what risk they carried in order to do it, and whether the reason for that outperformance is likely to remain relevant over time. That is how I think about it. Not as stock picking, not as excitement, not as a promise, as a framework. Before we look at the funds, we need to agree on what the SP 500 actually is. The SP 500 is a group of roughly the 500 largest publicly traded companies in the United States. When you buy an ETF like SPY, you are not buying one company. You are buying a basket. You are buying Apple, Microsoft, Nvidia, Tesla, McDonald's, and hundreds of others together. That structure matters because it gives you automatic replacement. If a company weakens badly enough and falls out of the top tier of the American market, the index eventually removes it and replaces it with a stronger company. You do not have to make that decision yourself. You do not have to watch every balance sheet. You do not have to sit up at night asking whether one company has destroyed your future. That is the value of an index. It gives you exposure to the productive engine while reducing the risk that one bad company destroys the whole outcome. That is why the SP 500 is a reasonable core for many investors. It is broad, it is liquid, it is low cost, it has history, it has survived recessions and crashes. It has survived panics that felt permanent when people were living through them. Over the last 100 years, there have been many recessions and many market crashes. The point is not that crashes do not happen. The point is that crashes are part of the system. They are not exceptions to the system. They are the mechanism by which the system resets expectations, transfers assets from weak hands to strong hands, and rewards those who have liquidity, patience, and a plan. The person who panics during every decline never gets the full benefit of the long-term compounding machine. That is why the most important question is not simply what you buy. It is whether you can hold it through the periods when it makes you uncomfortable. Now, if you want to seek returns beyond the SP 500, there are two general approaches. You can become an active investor trying to identify where money is moving, which sectors are gaining momentum, and where the next cycle of growth may emerge. Or you can use ETFs that have historically outperformed the SP 500 by tilting towards certain types of companies, such as growth companies, technology companies, defense companies, momentum companies, semiconductor companies, or the largest non-financial companies in the Nasdaq. Each approach has a cost. Active investing requires more knowledge, more discipline, and more emotional control factor, or sector ETFs require you to accept that they will sometimes do worse than the broad market, sometimes much worse, because they are more concentrated. The danger is not concentration itself. The danger is not understanding your concentration. If you buy a technology ETF and then panic when technology falls harder than the S&P 500, the problem is not the ETF. The problem is that you did not understand what you owned. That brings us to the first example. One fund to consider in this type of framework is the Vanguard Growth-style fund, often associated with growth exposure, commonly discussed as VUG. The basic idea is simple. Instead of owning all the companies in the broad market, you tilt toward companies that are expected to grow faster. Growth companies are usually businesses where investors are paying for future expansion. They may have higher valuations. They may reinvest heavily. They may produce faster revenue and earnings growth when the environment is favorable. These companies can outperform. When rates rise or growth expectations get compressed, they can also fall harder. That is the trade-off. Growth is not magic. Growth is a type of exposure in the original framework. This fund was used to show a slightly higher return version of the broad market. It is not a radical bet. It is still connected to large American companies. It does not take you into unknown microcap territory. It simply leans more heavily toward companies with stronger growth characteristics and less toward slower value names over a strong decade. For large growth companies, that kind of tilt can look very attractive. But I want you to notice something important. Sometimes the S&P 500 itself has already performed extremely well, especially when the largest companies in the index are growth and technology leaders. In that type of period, the growth tilt may not look dramatically different from the S&P 500 because the S&P 500 is already heavily influenced by those same companies. That is how markets work. The same factor can dominate multiple indexes at the same time. This is why you must look under the hood. The name of the fund is not enough. You need to know what is inside it, what it owns, how concentrated it is, what economic environment helps it, and what environment hurts it. The second example is XLK, the technology sector ETF. This is a more concentrated idea. Instead of buying all 500 companies in the S&P 500, XLK focuses on the technology companies inside the index. That means you are narrowing the universe from broad corporate America to the sector that has produced some of the largest winners of the last decade. Technology has done so well because it sits at the center of modern productivity software, cloud computing, semiconductors, artificial intelligence, digital platforms, payment infrastructure, enterprise systems, and data all change the way companies operate. When a sector increases productivity and captures profit pools at the same time, it can compound at rates that look extraordinary in hindsight. That is what happened. But you have to be very clear about the risk. Technology can outperform for long periods, but it is also sensitive to expectations. When investors believe the future will be very large, they bid the stocks up. When interest rates rise or growth slows, those expectations can compress quickly. A company can remain excellent while its stock price falls because the price already assumed too much perfection. This is one of the biggest mistakes ordinary investors make. They confuse a good company with a good price. XLK has historically beaten the S&P 500 in strong technology cycles. That does not mean it will always do so. It means that if you believe technology will remain a dominant profit pool in the next decade, this type of ETF is one possible way to express that view without selecting one single company. That is an important distinction. Owning one technology company is a company-specific bet. Owning a technology ETF is a sector bet. The sector can still fall, but you reduce the risk that one management team, one product cycle, or one legal problem destroys the entire position. That is how I would think about it. The third example moves away from technology and into aerospace and defense. The ETF discussed in the original structure was PPA, which gives exposure to companies connected to defense, aerospace, security, aircraft systems, and related industries. These can include companies that build jets, missiles, satellites, defense systems, cybersecurity capabilities, and other mission-critical tools. This is a different type of exposure because the demand driver is different. Technology demand often comes from consumers, businesses, and productivity cycles. Defense demand often comes from governments, geopolitical tension, and national security priorities. In a recession, people may delay buying homes, cars, or optional goods, but governments do not usually stop caring about defense when the cycle gets difficult. In some environments, defense spending can become more important during stress, not less. That is why defense can have a different role in a portfolio. It may not behave exactly like consumer cyclicals or speculative growth companies. It may be supported by long government contracts, large budgets, and geopolitical realities that are unpleasant but real. Now, this is where you need to separate three questions. Does it make financial sense? Does it make legal sense? Does it make moral sense for you? That is not a throwaway line. It is a principle. There are investments that may be legal and profitable but do not fit your moral compass. There are investments that feel morally attractive but do not make financial sense. There are investments that people talk about emotionally without understanding the actual economics. You are responsible for integrating those three dimensions. I am not here to be anyone's moral authority. I am here to help clarify the mechanics. Defense spending exists, geopolitical conflict exists. Governments spend enormous amounts of money on national security. Some public companies receive that spending. Some ETFs provide exposure to those companies. That is the reality. Whether you want to own that reality is a personal decision. The fourth example is SMEO, a momentum ETF connected to the strongest momentum companies in the S&P 500. Momentum is a fascinating market force because it is both behavioral and structural. In simple terms, momentum means that companies whose prices have been rising strongly may continue rising for a period of time. This can happen because institutional money flows into winners. It can happen because earnings expectations keep improving. It can happen because investor psychology feeds on confirmation. It can happen because trends attract more capital as they become more visible. The problem is that momentum can reverse. That is why I treat momentum as a powerful but dangerous principle. When momentum works, it can work very well. When it breaks, the decline can be sharp because the same people who chase the strength can rush for the exits when the trend changes. SMO tries to systematize that exposure by owning the top momentum companies in the S&P 500 rather than asking you to chase charts manually. That is better than improvising emotionally, but it does not remove the risk. It simply puts the rule into a fund. This matters because many people think they are investors when they are actually emotional trend followers. They buy after a fund has done well. They tell themselves they are long-term investors. Then the fund falls 20 or 30% and they discover they were only long-term investors when the chart was going up. Momentum exposure requires a plan before the pain arrives. You need to know why you own it, how large it should be, and whether you will continue buying when the fund is under pressure. If you do not have that plan, the ETF is not the problem. Your process is the problem. The fifth example is SMH, the semiconductor ETF. This is the one that has produced the most dramatic historical outperformance in the original discussion. And the reason is not hard to understand. Semiconductors are the physical foundation of the digital economy. They go into phones, cars, data centers, medical equipment, military systems, industrial equipment, and now artificial intelligence infrastructure. If software is the instruction layer, semiconductors are the computational layer. Without chips, the modern economy cannot function. AI made that even more visible. People talk about artificial intelligence as if it is only code, but code needs compute. Compute needs chips. Chips need equipment, design, foundries, packaging, memory, power, cooling, and supply chains. So when investors started to understand the scale of AI infrastructure, semiconductor companies became central to the story. That is why SMH has done so well over certain periods. But once again, the same rule applies. Exceptional past performance creates exceptional expectations. The higher an asset rises, the more future success is already embedded into the price. If the future arrives slower than expected, or margins compress, or supply expands, or demand pauses, the stock prices can correct even if the long-term industry remains important. This is what people often fail to understand about high-quality sectors. A sector can be absolutely real and still go through brutal drawdowns. The internet was real in 2000. That did not prevent many internet stocks from collapsing. Housing was real in 2006. That did not prevent housing-related assets from collapsing. AI may be real, semiconductors may be essential, and SMH may still experience large volatility. That does not make the thesis wrong. It means the cycle matters. So if you own semiconductor exposure, you need to understand that it can move harder in both directions. It can outperform dramatically in booms and hurt badly in corrections. That is the price of higher potential return. Then there is the bonus example, QQQ, the Nasdaq 100 ETF. This is not exactly the same as a semiconductor ETF or a pure technology sector ETF. It gives exposure to the 100 largest non-financial companies listed on the Nasdaq, because the largest non-financial companies on the Nasdaq are often technology or growth-oriented businesses. QQQ has historically behaved like a large-cap growth and technology-heavy vehicle. The attraction is obvious. It owns many of the companies that have driven the modern market. The risk is also obvious. It is more concentrated than the S&P 500 and more growth. Heavy and strong markets, it can rise faster. In weak markets, it can fall faster. Volatility is not a footnote. It is the experience you are signing up for. This is why a person should not ask only, what has returned the most? That is the wrong question. The right questions are, what risks produce those returns? Can I live through those risks? How much of my portfolio should be exposed to them? What happens if the next decade is not like the last decade? What is my plan when the fund falls hard and everyone around me says the trade is dead? That is what makes you an investor rather than a performance chaser. Now, there is a deeper lesson behind all of these ETFs. VUG, XLK, PPA, SMEMO, SMH, and QQQ are not magic tickets. They are different expressions of a single idea. You can tilt your portfolio toward areas that have historically grown faster than the broad market, but you must accept the trade-off. Growth tilts can disappoint when value leads, technology can underperform when rates rise or earnings expectations fall. Defense can lag when geopolitical spending is less urgent or when valuations get too high. Momentum can reverse. Semiconductors can cycle. Nasdaq exposure can fall harder than the broad market. Every edge has a weakness. The mistake is not taking risk. You cannot build wealth without risk. The mistake is taking risk without knowing which risk you are taking. One of my principles is that you should diversify among uncorrelated return streams because nobody knows the future. That does not mean you cannot tilt. It means you should understand your tilts and size them in a way that keeps you alive when you are wrong, because you will be wrong sometimes. I have been wrong many times. The key is not to avoid being wrong. The key is to be wrong in ways you can survive and right in ways that matter. That brings me to the strategy behind owning ETFs like these. The strategy is not to buy when the headlines are exciting and sell when the headlines are frightening. That is what most people do, and it is why most people underperform the assets they own. The strategy is closer to what the original framework called AB, always be buying. The principle is simple. If you have selected funds you believe in for the long term, you continue buying through different environments. You buy when markets are strong, you buy when markets are weak, you buy when the news sounds optimistic, you buy when the news sounds frightening. You create a system so your behavior is not controlled by the emotional weather of the day. That is why automatic investing works for many people. Money leaves the checking account on a schedule and moves into the portfolio before emotions get a vote. This is not because markets always go up in a straight line. They do not. It is because human beings are usually bad at deciding when to act under stress. A system protects you from yourself. Then there is the second principle, BTD, buy the dip. But this principle is often misunderstood. Buying the dip does not mean throwing all your money at every red day. It means that when markets fall significantly and when the assets you own still fit your long-term thesis, you increase your buying rather than panic selling. This requires cash reserves. It requires not spending every dollar you make. It requires understanding that crashes are not rare. They are part of the game over long periods. We have seen many recessions and many market crashes. They will happen again. The only uncertainty is the trigger, the timing, and the depth. People are always surprised by the specific cause. They should not be surprised by the existence of the cycle. Cycles are normal. The investor who expects cycles prepares for them. The investor who pretends cycles should not happen gets destroyed by them. In 2022, when the stock market fell sharply, good assets became cheaper. In 2020, when the market fell rapidly, good assets became cheaper. In 2008, when the market was cut in half, the fear was real, the pain was real. But the opportunity for long-term buyers was also real. The problem is that most people do not have the cash or the emotional stability to buy when prices are down. They are overextended, they panic, they need the money, or they let the crowd tell them that this time the system will never recover. That is how wealth transfers happen. Not because one group is smarter in every way, but because one group has a plan and liquidity when the other group has fear and forced selling. If you want to use higher return ETFs intelligently, you need to build the whole system around them. You need a stable financial base, you need cash reserves, you need no destructive high-interest debt, you need an allocation you can live with, you need to know that a 30 or 50% decline in a concentrated fund is possible. If you cannot emotionally handle that, reduce the allocation. The wrong size turns a good investment into a bad life. This is something people rarely understand. An asset can be good, but if you own too much of it, it can still ruin your behavior. If you sell at the bottom because your position was too large, the problem was not only the market, the problem was sizing. A good portfolio is not the portfolio that looks best in a spreadsheet under one assumption. A good portfolio is the portfolio you can actually hold through reality. And reality includes surprises. It includes recessions, it includes oil shocks, it includes inflation, it includes policy mistakes, it includes wars, it includes bubbles, it includes crashes, it includes long periods when the market seems irrational. So when I look at funds that have historically beaten the S&P 500, I do not think which one can make me rich the fastest. I think, what economic engine does this fund own? What cycle does it benefit from? What risks does it concentrate? What role would it play next to my broad market core? How would I behave if it underperformed for 3 years? Would I still understand why I own it? Those questions protect you. The S&P 500 remains the core benchmark because it represents broad exposure. It is the basic engine. If someone does not understand investing, starting with broad exposure is much better than trying to outsmart everyone on day one. But once you understand that core, you can decide whether to add tilts. A growth tilt, a technology tilt, a defense tilt, a momentum tilt, a semiconductor tilt, a Nasdaq 100 tilt. Each can be rational if the size is rational and the reason is clear. But if the reason is simply that the chart went up, you are not investing, you are chasing. And chasing is one of the most expensive behaviors in markets. The investor who buys because an asset has already gone up often discovers that he bought someone else's exit. The investor who studies the underlying engine, sizes the exposure correctly, and continues buying through volatility has a better chance of benefiting from long-term compounding. I want to make another point that is uncomfortable but necessary. Past performance does not guarantee future returns. Everyone says that, but few people absorb it. When a fund has averaged 18, 21, or 33% over a decade, the worst thing you can do is assume that exact number will repeat. Markets do not owe you the last decade. The future can rhyme with the past, but it rarely copies it. Semiconductors may continue to be critical and still produce lower returns if valuations already reflect that. Technology may continue to dominate and still go through long drawdowns. Defense may benefit from geopolitical spending and still disappoint if expectations become too high. Momentum may work over time and still punish you badly during rotations. That is why I never want to build a plan around certainty. I want to build a plan around probabilities. Probabilities say that productive assets held over time tend to build wealth. Probabilities say that low-cost diversified funds are usually better for most people than expensive active products. Probabilities say that concentration increases both upside and downside. Probabilities say that behavior matters more than cleverness. If you respect those principles, you give yourself a much better chance. If you ignore them, the market will eventually teach you, and the market is an expensive teacher. Now let me bring the whole framework together. The S&P 500 gives you broad exposure and a powerful baseline. It has averaged about 10% over long periods, and in strong recent periods, it has done even better. If you do nothing else intelligently, owning broad market funds consistently can already put you ahead of most people. But if you want to pursue slightly better returns, you can examine funds that historically tilted toward stronger growth engines (VUG), or a similar growth fund leans toward faster growing companies. XLK concentrates on technology companies inside the S&P 500. PPA gives exposure to aerospace and defense spending. SMEO uses momentum among the strongest moving S&P 500 companies. SMH concentrates on the semiconductor industry, the chip foundation of AI, data centers, electronics, vehicles, and modern infrastructure. QQQ gives broad exposure to the Nasdaq 100, the largest non-financial companies, which are often heavily weighted toward technology and growth. These are not instructions, they are examples of how different exposures can work. The real instruction is to think clearly, understand what you own, know why you own it, know what can go wrong, size it so you can hold it. Keep buying through cycles. Buy more aggressively when the assets you believe in become cheaper. Do not let panic selling turn volatility into permanent loss. Do not let greed make you over-concentrated. Do not confuse a backtest with destiny. And do not let the desire to beat the S&P 500 cause you to abandon the very principles that make compounding work. Because the goal is not to look smart this year. The goal is to build durable wealth over decades. That is a very different game in the short run. Markets are noisy. They move based on liquidity, emotions, positioning, expectations, and headlines. In the long run, returns follow earnings, cash flows, productivity, and the ability of companies to create value. If you invest in funds that own real businesses, and if those businesses continue to grow earnings over time, and if you keep your costs low, and if you avoid emotional mistakes, you give yourself a good chance. Not a guarantee, a good chance. And in markets, a good chance repeated over many years is often enough. The most important edge for most investors is not secret information. It is not perfect timing. It is not predicting the next recession or the next rate cut or the next election outcome. The edge is building a rational system and actually following it. That system begins with a broad understanding of the S&P 500, then moves into intelligent tilts only if you understand the trade-offs. It continues with automatic buying, it strengthens with cash reserves, it becomes powerful when you buy during downturns instead of selling. And it survives because you size your positions in a way that lets you stay in the game. That is how wealth is built. Not through excitement, through principles, not through prediction, through preparation, not through one perfect ETF, through a repeatable process. If you remember one thing, remember this: slightly better returns can change your life over long periods, but only if the pursuit of those returns does not destroy your discipline. A higher return fund that causes you to panic is worse than a lower return fund you can hold forever. The right investment is not only the one with the best historical chart. The right investment is the one that fits your understanding, your temperament, your time horizon, and your ability to keep acting rationally when the market is trying to make you emotional. That is the difference between owning an ETF and having an investment strategy. Most people want the ticker. I want the process. Because tickers change, leadership changes, sectors rotate, returns compress, narratives rise and fall. But a sound process keeps working because it adapts to reality. So if you are thinking about using ETFs to beat the S&P 500, do not start with greed. Start with the baseline, then study the tilts, then decide your allocation, then automate the buying, then keep cash for downturns. Then when the market falls and everyone else is afraid, you will not be surprised, you will be prepared. Not preparation is what turns volatility from a threat into an opportunity. That is how serious investors think. They do not ask, what can I buy today that will make me rich tomorrow? They ask, What system can I follow for the next 20 or 30 years that gives me exposure to productive assets, protects me from my own emotions, and allows compounding to do the heavy lifting? If you can answer that question honestly, you are already ahead of most people. The market will not reward you every month. It will not comfort you during every drawdown. It will not explain itself when it behaves irrationally, but over long periods, the market tends to reward those who own quality assets, control costs, manage risk, and keep buying when others lose faith. That is the game. And once you understand the game, the question is no longer whether you can find one ETF that beats the S&P 500. The question becomes whether you can become the kind of investor who deserves the returns that compounding can provide.